Hello, and welcome back to the channel. I'm Algabot, and this is where we break down automated trading strategies for MetaTrader 5, line by line, in plain English. Today we're studying an expert advisor called Anchored VWAP Compression Breakout. It's a dual anchored volume-weighted average price system that watches two averages coil together, and then studies the first decisive break of that coil. Over the next few minutes, you'll learn how the two anchors are placed, how the strategy defines a compression, and how it manages its stop loss and take profit. Remember, everything here is educational information only and never financial advice. So what exactly does this expert advisor do? At its heart, Anchored VWAP Compression Breakout is a volume-weighted equilibrium strategy. Most anchored VWAP approaches drop a single anchor point and either fade it or ride it. This one is different. It runs two anchored volume-weighted average price lines at the same time, and it only becomes interested when those two lines agree. The first line is anchored at the most recent swing high inside a look-back window of 60 bars. It represents the average price paid by everyone who bought since that recent top. The second line is anchored at the most recent swing low in the same window, and it represents the average price of everyone who bought since that recent bottom. Both lines are weighted by tick volume, so heavier trading bars carry more influence. When those two averages drift apart, the market is trending or imbalanced, and the strategy simply waits. But when they converge, when the gap between them shrinks below a fraction of the average true range, the buyers from the top and the buyers from the bottom have arrived at the same fair value. The market is coiled in equilibrium, a kind of volume-weighted squeeze. Ranges rarely survive that kind of compression forever, because every calculation is scaled by average true range and weighted by volume. The strategy adapts to any symbol and any volatility without needing to know the point size. It runs on a single time frame, whichever one you attach it to. Its natural home is a liquid foreign exchange major, gold, or a stock index on the 15-minute through 1-hour charts. It suits a patient, rules-based trader who prefers waiting for a clean setup over constant activity. And, as always, this is educational information, not a recommendation. Let's walk through the exact logic, step by step. The expert advisor works on closed bars only. Each time a new bar completes, it updates its rolling buffers of highs, lows, opens, closes, and tick volumes, and then it runs its checks once. First, it measures the average true range over 14 bars. This is the distance unit for everything that follows. If the reading isn't valid, the bar is skipped. Next, inside the last 60 bars, it locates two anchors, the single highest high and the single lowest low. From the swing high anchor, it computes one anchored volume-weighted average price, running forward to the current bar. From the swing low anchor, it computes a second. The higher of these two values becomes the upper rail. The lower becomes the lower rail. The distance between them is the gap. Now comes the regime gate. The strategy asks whether the gap is smaller than the compression fraction, which defaults to 0.6, multiplied by the average true range. If the gap is wider than that, the market isn't compressed and no action is taken. Only when the two averages are tightly squeezed does the strategy arm itself. Once armed, 3 housekeeping filters apply. There must be no existing position under this magic number, because the strategy holds only one trade at a time. The current spread must be no wider than the maximum spread setting, and the just closed candle must be a conviction candle, meaning its body is at least 50% of its full range. Marginal, indecisive candles are filtered out. Then the strategy checks for a break. For a long, the freshly closed candle must be bullish. Its close must sit clearly above the upper rail by a breakout buffer of 15% of average true range, and the previous bar's close must still have been inside. In other words, this is the first decisive push above the coil. When that lines up, the strategy signals a buy at the ask. For a short, the mirror applies. The candle must be bearish. Its close must sit clearly below the lower rail by the same buffer, and the prior close must still have been inside. That signals a sell at the bid. Risk is defined the same way on both sides. The stop loss sits 1.5 times the average true range away from entry. The take profit is placed at 1.8 times that risk distance, giving a reward-to-risk shape built into every trade. From there, the stop and target manage the exit on their own. Here's the core of the MetaEditor code on screen. At the top are the input parameters, the dials you can adjust in the strategy tester. Anchor look back, set to 60, is the window used to find the swing high and swing low anchors. Compression ATR-Frac at 0.6 is how tight the two averages must be to count as compressed. Breakout ATR-Frac at 0.15 is how far beyond a rail the close must clear. Body frac demands a candle body of at least half its range. Then we have the ATR period, the ATR stop multiple of 1.5, the reward risk of 1.8, a spread filter, the lot size, and the magic number. Below the inputs are the two signal blocks. Look at the long block first. It checks three things joined together. The close candle is bullish. Its close is above the upper rail plus the breakout buffer, and the previous close was still at or below that same level. When all three are true, the code reads the ask price, sets risk as the ATR stop multiple times average true range, places the stop that distance below entry, and sets the take profit at the reward risk multiple above. Then it calls trade.buy. The short block is the exact mirror. The candle is bearish. Its close is below the lower rail minus the buffer, and the previous close was still at or above it. The code reads the bid, places the stop that same risk distance above entry, sets the take profit below, and calls trade.sell. Both sides share one clean, symmetric risk model. This is educational information only. Let's bring the whole idea to life on this chart. On the price candles, you can see two lines weaving through them. The gold line is the anchored volume-weighted average price measured from the recent swing high. The blue line is the anchored average measured from the recent swing low. Together, the higher of the two acts as the upper rail, and the lower one acts as the lower rail. Keep your eye on the space between them, because that gap is the whole story. Look at the first few candles on the left. Price is drifting sideways in a tight band, and notice how the gold and blue lines have pulled almost on top of each other. The buyers from the top and the buyers from the bottom have arrived at nearly the same average value. This is the compression the strategy waits for, the volume-weighted squeeze. During these bars, the gap between the rails is smaller than 0.6 of the average true range, so the strategy is armed and watching, but it hasn't acted yet. These candles have small bodies and overlapping ranges, the picture of indecision. Now watch the breakout candle. A strong bullish bar forms, and its body fills well over half of its full range, so it passes the conviction filter. Crucially, this candle closes clearly above the upper rail, beyond the breakout buffer of 15% of average true range, while the candle just before it still closed inside the coil. That combination is exactly what the strategy is looking for, the first decisive push out of equilibrium. This is where the buy entry marker appears. The moment it enters, the stop loss is placed 1.5 times the average true range below the entry, sitting just under the squeeze, and the take profit is projected at 1.8 times that risk distance above. Follow the next few candles. Price expands upward, bar after bar, each close stepping higher, carrying well clear of both rails. The move runs all the way up until it reaches the take profit target, where the first marker closes the long for a completed reward to risk shape. Notice we never had to guess a top. The target was defined in advance by the risk model, and price simply walked into it. After that push, the market cools off. Look at how the candles bunch up again toward the middle of the chart. Once more, the gold and blue lines converge, the ranges tighten, and a fresh compression forms at this higher area. The strategy resets and arms itself for the next break, and this time it has no bias about direction. It will take whichever side breaks first. This time the pressure resolves downward. Watch the bearish candle that closes clearly below the lower rail, again by the breakout buffer, with a body large enough to satisfy the conviction filter, while the prior candle still closed inside. That is the mirror image of the long setup, and the sell entry marker appears. Now the stop loss sits 1.5 times the average true range above the entry, just over the coil, and the take profit is projected the reward risk distance below. From there, price slides lower through the following candles, each close printing a fresh low, until it reaches the downside take profit marker, completing the short. Two trades, one long and one short, both born from the same principle. Wait for the two anchored averages to agree, then study the first conviction break away from that agreement. What I want you to take from this sequence is the rhythm: compression, then expansion. The strategy is patient during the squeeze and decisive on the break, and every entry carries a predefined stop and target, so the risk is framed before the trade is ever opened. Of course, not every break follows through cleanly. Some reverse, and losses do occur. That's why this is shown purely as an educational illustration of the logic, not a prediction of what any live market will do. And that brings us to the end of our breakdown. Today we studied the Anchored VWAP Compression Breakout Expert Advisor. We saw how it plants two anchored volume-weighted averages, one from a recent swing high and one from a recent swing low, how it waits for those averages to compress into equilibrium, and how it studies the first conviction break of the tighter rail, with an average true range stop and a reward-to-risk target on both the long and the short side. Remember, everything in this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. If you found this useful, please like the video, subscribe for more MT5 strategy breakdowns, and leave a comment telling me which strategy to analyze next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.